Hello, welcome to another crypto chart. The week has ended. Markets are closed. So let's take a look in the weekly charts and see what can we expect for the market in the coming weeks, days, and months, eventually years. Shall we? Starting with the, let me just find out here, the S&P, that's right here. So what have we got? We're going to analyze the trend that started after the subprime in March 2009, and then come back to weekly chart and on a log scale, and I'm going to show you something that pops into our eyes, which is an engulfing pattern that this week made over last week. So this is important, right? Yes, but one of the things that I think we have to consider always, a good technical analyst have always to consider is the importance of each of the indications that we have. So what would mean an engulfing pattern after a climax, a downward climax? It would mean a reversal. It would mean that the market that was coming down is to go up. Okay, but we have to consider that the candlestick indications are sort of a change in the mood, in the psychology of the market, as has been described by Steve Nissen, that brought candlestick to the Western society. So that means that the market, it's changing psychology. It may eventually be a red line, or that something is changing. Another option would be for it to be a situation in which the market would stand still for a while, accumulating, doing a flag, for instance. On a weekly chart, we would think of maybe a month and a half or even 2 months that the market would, go sideways, flagging down. And eventually, so 3 possibilities. The possibility that this is just a red flag that the market is giving us, but it will come lower. Eventually, the market is going to do a sort of a flag. And the third option would be for the market to reverse. And of course, you have to consider the possibility for the market to react to the down movement. I'm not talking about trend purposely, because we're not in a long-term trend yet. We're in a short-term trend. Yes, so far the market has dropped only for a month, and I'll tell you what. I've seen some newspapers saying that the market is back on a bull market, so that we would have witnessed the shortest bear market in history. But that's only because someone took as granted that whenever the market oscillates 20% is in a bull market, and that's absolutely not correct. This was something that Charles Dow pointed out in 1901. That was before the 29 crash. That was before the 87 crash. That was before the 97 Asia crisis, Mexican crisis, subprime, and so on. We have all these data now. It's another market, so no one should stand with the idea that eventually, you know what? You guys, you you fundamental analysts, you let us technical analysts say about trends, because trends, it's our subject. If the market is in a trend or is it not in a trend, that's our expertise. And the expertise comes also from Charles Dow that says that the market would be in a bear market whenever it would break the first low that it makes. And why is that? Because whenever the market comes down, produces a low, and then goes up reacting, and then comes down again and breaks this support level, it will be producing the second impulsive wave. So we say that the market is trending impulsive waves downwards. It's a trend for the market to produce downward movements whenever it starts the second downward movement. The second downward movement, if we come back to the S&P, would begin whenever this first movement, the low of this first movement, is broken. So that could happen with a accumulation here that will produce a flag, a downward flag, or eventually it will produce a reaction that would produce an A, B, C that could eventually make the market come back and do a pullback to this former support trend line of the trend. So coming back to what I was saying, we shouldn't expect that one upward movement of 20%, first of all, reverts the down trend, because as I was saying, we have to consider what's most important. And I'm going to ask you, you're going to tell me, write on the comments too if you want. What do you think it's more important? The fact that the market produced now what is more important in terms of the long term? We're not talking about Monday, Tuesday, Wednesday, or next week. We're talking about whether the market is going into a bear market, whether we've seen only a correction of the bull market that is going to continue. That's what interests in the long term, in the long run, right? For most of the people that have a portfolio in stocks, that's the important thing. So I'm going to ask you again. What's more important, the fact that the market engulfed in a support level, which is what we're seeing right here? The support level is important, yes. Why is it important, Fausto? Well, it's important because the last time the market reached this level, it went up for 40% in a short period, in a year and a half. So now the market broke this level and reverted and produced an engulfing. So the question is, what's more important, this reversal with a engulfing pattern, or the fact that the market broke the support line that comes from 2008 actually, producing 1, 2, 3, 4 points and a upward channel. A 10, 11 year upward channel. I'm going to answer you, of course. After all, I'm the YouTuber analyst here, right? I think it's much more important the fact that the market broke the trend line, this long-term trend line. But it engulfed in a support. It might have produced a bear trap. Yes, but that's all happening very near the top. So whenever things happen near the top, you kind of don't agree very much. So what I think is going to happen here is an accumulation, or eventually an ABC for the market to make a pullback to the former trend line. And if that happens, then we just gonna have a pullback, and we're gonna have the first reaction of the bear market that I think we're entering in. We're witnessing in my opinion, we're witnessing the beginning of a bear market. What is a bear market? It's a long-term downward trend. Okay, so that said, let's take a look in the other assets. Beginning with the Nasdaq, I think, yeah, weekly chart, we have it here already. So what have we done? What can we see in the Nasdaq? It also broke this support trend line, and what I'm seeing here so far is it's just a pullback to the former support line, and I think same thing. I think it's just going down. Oh, sorry, I'm in the was in the daily chart, now in the weekly chart. We also see a reversal here, but this reversal brought the market already to the former trend support trend line, and eventually I think we're going to see some kind of bear flag here or something like that, because it has already gone to where I suppose it could eventually. So that's my opinion, that's my analysis for the Dow. And let's take a look in for the Nasdaq, and let's take a look in the Dow now. That's the 107-year chart, long-term chart, weekly long-term chart of the Dow Jones Industrial Average. We see that it was up near the moon, right, in this century channel, and it also broke the support trend line, and it also engulfed. So it's the same thing. I think it's much more important that it broke the support trend line than the fact that it engulfed right here. These might be telling us that the market is going to be sideways from now on for some time on. I remind you that after the first drop in 1929, the market stood 5 months in the first reaction, and that was before it dropped another 83%. So that's something we could expect too. But the most important thing is that, why am I insisting that it's more important that we had the trend lines broken? Because then you start to consider what's happening now as the beginning of a bear market. And whenever you're acting as a trader or as a portfolio manager in a bear market, you have to know that whenever you buy, you're going to be counter trending. And to counter trend means that you have to use stops, because in the long run, you're not going to do good, you're going to do bad, So use stops. Very well. So now let's take a look at the other assets. Like, for instance, oil. And here's oil. It's right over here, oil. Well, oil's back and right in the middle. Almost in the middle of this range. Yeah, it's actually exactly in the middle of this range that it inhabited for 20 years. It inhabited this range, and it's back there. I think it's more than time, because I happen to think that oil is going to... You know why? Because as somebody said, I think it was the Ministry of Saudi Arabia. He said, the Stone Age didn't finish for the lack of stones. So I think oil is not going to finish because the lack of oil. Because electricity is coming, it's already here. We're seeing it. We're seeing drones carrying people, electrically powered. We're seeing planes electrically powered. We're seeing cars. There's Tesla, and then there's the sun energy. And there's Bill Gates doing the mirrors that are going to power aluminum and cement industries. And so I think the days of oil are just counted. But for us here, oil is telling that there is not going to be, no, he's telling actually, that's something I used to say when the market was, when oil was coming down in here. I used to say that, oil is not telling us that there is going to be an economic expansion. On the opposite, it's telling us that there's going to be a retraction. It gave us a sign. I don't know if it gave us a sign of the corona, but the thing is, I think the corona was just the needle that popped the bubble that was in the stock markets. Why is that? Well, I've said here in the channel already, but Sir Mervyn King, former president of the Bank of England, spoke in a conference that I attended some time ago, and he said that they had a problem in 2008. They, I assume, meant that it was him, president of the Fed, Bank of Europe, and Bank of Japan. And he said, well, we had a problem because we gave too much credit. And then we had to solve that problem. So then he looks at the public and says, so how did we solve the problem of having given too much credit? And then he says, we gave more credit. So my friend, that's what happened in 2008. I heard that, my ears heard that from the former president of the Bank of England. So everything that happened after subprime, it's a lie. It's completely artificial. So I am absolutely sure that this here was the market in a bubble. All this upward trend here that took the prices from the low after the subprime and made them rise 276%. That's without inflation, because if we leave inflation, this is going to be much more. It's going from 276 to, look at that, to the upward trend that took with inflation 357%. So this was all artificial, So back to the to oil here. Well, what we've seen here so far in the daily market. Let's take a look in the weekly. Is that, well, I think it's probably willing to taste the $20 level. And back to the daily chart. So I think that's a good place for it to stay, to go sideways. There's something else we can do here, which is to project this downtrend from the top here, see what it takes us. It will take us right to $20 level. So I think the oil is going there and is staying there. Now for gold, I want to bring you something new here, which is, I have a friend, 16-year-old friend. His name is Mario Garro, and he just gave a interview to a important channel, financial channel here in Brazil, and he was my student. I'm a friend of all his family as well. They live nearby here in the middle of the state of São Paulo in Brazil, and he was my student, and we keep changing some ideas, and he have read lots of things that very important YouTubers are saying about gold. about the possibility for the big the big ones, let's put it this way, make a sort of a refresh in the economic financial of the world, financials of the world. And in that case, gold would go to $80,000. And then he said, Fausto, look at that. I haven't thought of that, because all I've thought so far, I came just until the last stop. I was considering, gold. Here's gold. I was considering, let's move it a little downward here. I was considering these as a inverted head and shoulders that project the market to go back to the top, which was 18 or 1900. And so I was working with this possibility. But I just want to show you that if this top is breaking, we should project this upward movement from here, and it would go right into $8,000. So that would back the analysis that some people are saying in the internet, that gold could go to up to $8,000 an ounce. So, but in the meantime, let's just take a look in the daily chart here and see that what I think happened was something similar to what happened in 2008, that gold felt in the beginning. Gold felt in October 2008. Look at that. Here's October. That's the crash. That's when the crash happened in 2008. Gold felt almost 25% before taking off for a upward movement of 173% that happened in 1, 2, 3 years. Not bad, right? So why did gold felt? Same reason why Bitcoin, I think Bitcoin felt now. Whenever things are ugly in the stock markets, whenever hedge funds have to make cash in order to pay their responsibilities with their investors, you know, whenever the investors start calling back for their money, they have to get liquidity. So they sell whatever has liquidity. Gold has liquidity. Bitcoin has liquidity. The stocks here in Brazil, the blue chips here in Brazil have a lot of liquidity, like Petrobras and Vale do Rio Doce. They have a lot of liquidity. Same thing with blue chips on India, Russia, Europe, and so on. So whenever the S&P falls, everything falls alike. Then, after the first drop, things start to get more clear, or even more ugly sometimes, as it happened in 1929. And then people start searching for stores of value and things like that. And then gold enters Bitcoin. Gold has gone up, Bitcoin has gone up since the first stall. So back to the gold chart here. Look at that. The market stalled, recovered almost everything, and now I think it's clear that it is flagging up. It's going to flag up or pan it up or something like that, and it's going to break this 1700, and it's probably going to the 1800 or 2000, which is very near, right? The top here of 2011 was 1900. So that's for gold and oil. And now I just want to show you other indexes, like for instance the transportation index, to show you that the DJTA Jones Transportation Index, which is very important, has reached 6,500, which is a very important support level over here and very near to the first Fibonacci correction level. That's important. So what does that mean? That means that it felt the support level and it reacted. Now, so people start saying that the market, it's back on a bull market. You know why? Because from bottom to top, it raised 24%. So that's just statistics, you know, and trends do not respect statistics, especially statistic that was written 105 years ago by Charles Dow. Oh, whenever the market, that was in 1901 when Charles Dow wrote his articles in the Wall Street Journal. Now it's different. You have to pick the concept, not the word of the letter. So no, the market has not reversed. The chances, big chance is that the market is just correcting. We're seeing, the market is reacting because let me teach you that don't know too much about technical analysis a simple term of technical analysis. Whenever the market is going up, falls and then goes up again, breaking the last top, we call this as a correction. So the market is going up, corrects, and then goes up again. Whenever it's in the downtrend, the market goes down, react, and then comes down again. So in the market, in trends, in a bull market, there's corrections, and then the market goes up. The synonym of, or the cousin of the correction is a accumulation. The market either corrects with eventually an ABC, which is a corrective wave, right? Or it accumulates. We may always say that it's correcting, somehow it's correcting the previous upward movement. And whenever it's coming down in a bear market, after an impulsive wave, the market will correct with an ABC. The market will react with an ABC, which is a corrective wave, but we say it is reacting to the downward trend. Or it will come down and eventually accumulate for then later on come down again. So, so that's my idea. I think we're going to see lots of corrections here. Actually, I'm seeing a lonely bird here. Look at that. You know what's that? That is a. It's not it's not a quote. It's a bad tick. Yeah, and I think that eventually, if I ask the software to update these quotes, it will correct. No, it didn't. So I must tell my team that it should correct the 25th of March because we have a bad tick on here. And you know what I do? I just hit. It's incredible the technology nowadays. Control C, and then I go to WhatsApp and I just look here for Enfoque Cryptos, and I just publish bad tick. Oops. And I just paste the chart. They're gonna see these and they're gonna correct these. Sorry for the commercial here. Let's go back to the Dow Jones Transportation. Now let's take a look in the utility index also. What happened to the utility index? It broke this support trend line. Well, first of all, it reached its 0.382 Fibonacci retracement level. Note that I'm using a log scale and a log Fibonacci. case some people are writing me telling the market has reached 0.61 level, but that's not true, because that's for people that use a arithmetic Fibonacci that changes. Arithmetic Fibonacci will make the quantity of points or pips from here to here, price difference 260, the same as here, price difference 260 as well. Whereas in the if we use a exponential Fibonacci, the difference is that from here to here you have a difference in points of $170, and from here to here you have $356. And why is that? Because from here to here you have 58.7%, which is the same percent difference from here to here, 58.7%. You see? So the exponential, the market, my friend, thinks exponentially. The market thinks in percent change. So that's why I think Fibonacci is to be used in a exponential side mode in a log scale. When you use exponential with exponential, it shows a arithmetic pattern. As you can see, the distance from here to here, it's the same of the distance from here to here. Okay, why is that? Because in a log scale, a same segment in this chart, same distance in a chart, means the same percent change. It will always mean the same percent change, right? So that said, the industrial average, the utility average corrected 0.382 Fibonacci level and came back, but now it just came back to the former support trend line. What is it going to happen? Well, I don't know. As you are aware, it's holding right there. As you are aware, there's 2 trillion, other 2 trillions being thrown by helicopter in the markets. That worked in 2008, 2009. I don't know if it's going to work right now, because I think, unfortunately, that's going to hurt the US a lot. Because there's something, let me tell you something. I know about inflation because I've lived in a country where we had 40% inflation. Hey, wait a little bit. A month. Yeah, 40% inflation a month. And when that was about to end, when President Collor went on and made the Collor plan, he took all the economies, all the money from everybody from the bank, he froze all the monies in the country. The inflation was reaching 80% a month. So I know about inflation. You know what's inflation? It's an elephant in the room, you know. It's, the party's going on, everybody's happy. All of a sudden you see there's an elephant in the room and nobody knows who placed that elephant there. And the thing is, he's not leaving. It's just not leaving. So here in Brazil, we would see some sector of the economy raise its price and then boom, everybody would raise their prices. Supermarkets would raise their prices. The gas stations would raise oil prices. The apartments for rent would raise their prices by 10%, 20%, 30%, whatever. And then everybody, the salaries would have to be raised because, Everybody knew that inflation was there, and so inflation comes and stays, and that happens when there is more money than the goods produced in the economy. It's as simple as that. And with the 15 trillion dollars that the U.S. has thrown into the economy from 2009 on, I think there's no chance for. Unfortunately, I am a person that loves the U.S. I love all the world, but I was there in the U.S. doing an exchange student program when I was 15. I went to a city, Binghamton, which is a city in between New York and Syracuse. Actually, I went to Conklin, very near to Binghamton, and I stayed there for 2 months and 23 days. Saw snow for the first time. I was 15, and I came back speaking fluent English. Thank God, because I have a lot of facility to speak languages. So, but unfortunately, I think the U.S. is going to get hurt out of this period in which it ruled the world. I think we're going to have very important changes in the world, and I also think that there's going to be an era before the coronavirus, after the coronavirus. So that's for the index. Now I just want to show you 4 stocks which I don't have here in our terminal in Foki, but I'm going to show you in right here in Trading View, and the first one is Apple. So look what happened to Apple. I am in weekly chart here. Apple just didn't do anything, just came near the support trend line. So we should keep an eye on the support trend line. We might take a look in the daily chart to see what is it doing. It reacted, left a hammer here, confirmed over here, which was the 24th, and then it is reverting again on a contest, important contest, which is this resistance trend line here, right? So we have had a dark cloud today. So that's for Apple. Now Microsoft is not that good. Let's take a look in the weekly chart. Always top down, right? Let's see what we can draw in terms of a trend line, more or less like here. Yeah, maybe. Well, there's not. We can have something from 2015 on. It's already 5 years, right? Yeah, we have this support trend line here, and so the market came and just touched it, and seems that it's reverting. But it's like I said, the S&P broke its support trend line. We're talking about the big 4. Now Google on the weekly chart. Oh no, let's take a look in the daily chart in Microsoft. So what is it doing? Came to the line, touched the line, and now it also gave us a dark cloud after a climax, upward climax, a dark cloud. And no, it's not very important contest, but there is a resistance here due to this low. Now Google, let's start the daily chart. What is it doing daily? Well, I think that's an accumulation. That's a sort of a flag. I think that's a flag that we could. Why did you come here? Yeah, let's see it from a little far away. So it's flagging on a very important support level. Look, market has been sideways from 2018 on, and it left us this very important support level here at $1,000. Now let's take a look in the weekly chart, which is like that. let's see if we can draw a support trend line here. I think we have to start here, and yeah, off it goes. You can put it here or you can put it here, doesn't change, because the important point is this one here. Could come to this point here, it doesn't matter. The trend line is broken. This upward movement that comes from 2008, actually starting in 2008 after the subprime, it's broken. Google has broken this trend line, and now what is it doing? Okay, it engulfed, but as I showed you, it seems that this is within a downward flag. So another thing that we should do here is draw Fibonacci corrective waves, retraction weekly chart. The trend is from here to here, right? I have to click here. So that means that if the market is to come back to retract to the first Fibonacci corrective level, it would come another 46% down. That's for the first Fibonacci corrective correction level. So there's a lot of potential on the downward side. So be aware if you're trading, if you're buying something now, don't forget your stop, because you know the party of the buy and hold, it's over. Now you have to be a trader to be in the market, because you can't count on the phrase that says that in the long term there is no mistake. Yes, there is going to be a lot of mistakes. So that's it for Google, and then let's finish with Amazon. In the weekly chart, no, that's very shy, a very shy upward trend line. Maybe here it's going to be better, right? Yeah, so Amazon didn't do anything. Oh, sorry, I'm not showing you. Here it is. Sorry if I didn't show Google, I'm not coming back. So yeah, Amazon just touched its support trend line. Support means blue trend line. And what have we got here in the weekly chart? Well, maybe Amazon is being favored because people are not leaving their house. They're going to buy a lot in Amazon. So it's an anti-cyclic stock, maybe. But let's take a look in the daily chart here. Here we go. What's happening? Is it flagging up or is it drifting up? I don't know. We have to wait and see. That one didn't clarify too much, right? So that's it for this video. Hope you enjoyed the video. If you liked it, don't forget to give us a thumb up. If you're not a subscriber yet, please subscribe to the channel. Tell your friends, and I'll see you next time. Ciao.